In 1776, Adam Smith gave us the idea of the invisible hand. For nearly 2.5 centuries, that hand was entirely human. Every trade and every market fluctuation was driven by our very human greed and our very human fear. If you looked at a trading floor in the late 20th century, you could literally hear that emotional decision-making. It was loud, chaotic, and most importantly, it was slow. The digital economy broke that speed limit. Take a look at this graph. This shows a standard e-commerce website's baseline traffic. When a massive influencer mentions the site on a live stream, traffic spikes vertically into this red failure zone in a matter of milliseconds. A human operator simply cannot click a mouse fast enough to authorize the emergency server funds needed to handle that load. Before a person even processes what is happening, the site crashes, and the business loses millions in sales. That speed vacuum required a completely different kind of financial architecture. Today, algorithms have moved beyond being dashboards for human traders. The code itself now acts as the independent trader. This is autonomous capitalism. In this system, code independently owns capital, assesses risk, and executes decisions with zero human input. When that massive e-commerce traffic spike hits, the company's internal AI immediately steps in. In a fraction of a second, it calculates the exact dollar amount of emergency computing power required to keep the servers online. These two nodes represent the company's AI and a decentralized capital pool. In 400 milliseconds, they negotiate a high-interest microloan. The moment the traffic surge passes, the debt is settled. The entire lifespan of this loan, from request to repayment plus interest, lasts exactly 3 seconds. This is AI to AI microlending. By removing the friction of human oversight, capital is deployed exactly when and where it is needed, with perfect efficiency. But that same lack of oversight introduces a massive vulnerability. Algorithms rely entirely on the data they ingest. A single corrupted data point or a tiny glitch in calculating a credit score can trigger an instant rejection. By engineering a perfectly efficient system, we have created the risk of flash defaults. A single glitch could cause billions of dollars of automated debt to cascade into failure in the time it takes you to blink, long before any human regulator could reach the kill switch. This extreme automation isn't restricted to private corporate servers. Autonomous capital has moved into public markets, where algorithms continuously monitor and monetize our collective social sentiment. These systems aggressively scrape localized news sites and Reddit threads and obscure message boards. They detect the subtle, bubbling early signs of a corporate PR crisis hours before the company's human executives even realize there's a problem. Once a critical threshold of negative sentiment is breached, the AI automatically executes thousands of high-frequency micro-shorts. It crushes the target company's stock price, generating massive profits by weaponizing localized public outrage. Historically, financial panics were intensely physical, slow-moving events. As you can see in this 19th century bank run, fear required people to physically gather outside a building to withdraw their cash. Today, anxiety spreads through encrypted group chats and social media feeds on our smartphones. When panic is digital, the resulting financial collapse is instantaneous. This map shows predictive bank run insurance in action. An algorithm ingests social anxiety data, searching for concentrated fear clusters over regional banks. When identified, it acts. 48 hours before panic materializes, it purchases massive put options, betting the stock will plummet. Because massive short positions are public data, the AI's predictive bet signals other traders to pull their money. By attempting to profit from a predicted collapse, the machine's own trading activity triggers the bank run it was designed to anticipate. If we pull back from the global macroeconomy, we find these same autonomous systems invading the most intimate financial space we have, the family. For centuries, generational wealth was managed by a static legal will. Now, those documents are being replaced by dynamic, AI-driven, multi-signature crypto wallets. Before passing away, a person trains an advanced language model on their personal diaries, their moral philosophies, and their entire financial history. The result is a flawless, decision-making digital clone. When the creator dies, the money isn't simply handed down. If an heir wants funds to buy a house or start a business, they have to sit in their living room and verbally pitch their life choices to a digital avatar of their dead parent. This is deep fake estate planning, It traps the surviving family members in a perpetual performance, forcing them to constantly justify their adulthood to a machine wearing their parents' face. Whether it is 3-second microloans, orchestrated banking collapses, or digital ghosts holding the family purse strings, the unifying thread is the total removal of human agency. Adam Smith's invisible hand has been severed. In our current financial architecture, our role has shifted from the primary driver of the system to a secondary component within it. Our public outrage, our financial panic, and our deeply held family values are now just the raw materials that algorithms harvest to execute their trades. If you had to face an AI version of your parents to get your inheritance, do you think you could pass the test?